the recording. So we are back for our weekly Tuesday loan desk session. And so we've got Joe Flannery with us today, and he's going to be talking about next level financing and some of those second mortgage options that clients will have. And so I'm going to let him take over from here. And so this is really good education wise to take back to your clients and let them know what their financing options can look like. So Joe, the floor is all yours.
Right on. Thanks, Ela. And it looks like know everyone pretty well here on the call. So let's just make it kind of more informal, even though it's being recorded and broadcasted to agents all over the Radius community. All right. So here's what I think are the 4 ways that you can tap into equity. So let's just put ourselves into the client's shoes here.
Hey, Joseph.
Yeah.
Quick ask is, can you turn off your mic in Kumos? I'm hearing an echo.
Oh, yeah, absolutely.
Thank you.
How's that?
Much better. Thanks.
Okay. Okay, so 4 ways to tap into equity: cash out refi, second mortgage, home equities, investment, reverse mortgage. So let's just put ourselves in the client's shoes here. They're already a homeowner. They may have a mortgage, they may not have a mortgage. They want to access their equity. Now, what are some reasons to access equity? Joel, putting you on the spot here. Give me one reason why someone would want to tap into equity. All right, Joel, you failed.
For HELOC.
I know, but what's the purpose of the cash?
Remodel to update their home.
All right, I'd say that's a pretty common one. All right, Brandon, you were saying something?
That's what I was saying. Home improvement, pay off an ex-wife.
Yep.
Retirement planning, would that be one?
Sure. If I would say I would put that in investment opportunity. So if you can take out cash at a certain rate and then get a higher return on your investment than what you're paying on the mortgage. I would say these are the 3 most common reasons why someone would tap into their equity: home improvement, debt consolidation, and which we'll just include into the divorce, and investment opportunity. So great reasons. And now as advisors, we want to provide them with kind of the solution that best aligns with their goals. Now, from 2013 to 2021, really the most popular way to tap into your equity was actually through a cash out refi. And so a cash out refinance is pretty simple. Basically, you have a mortgage, or maybe they don't even have a mortgage, but let's just say for this purpose, they have a mortgage, and you're going to replace that loan with a new mortgage plus a balance that is higher. So if they have a $300,000 mortgage and you do a new loan at a $400,000 mortgage, and let's say the closing costs are 0, then you're getting $100,000 cash out. And so you can run the numbers on kind of what a cash out refinance looks like. So you can see, we'll just do one in California. Let's say it's a home value of $800,000 and it's a new loan amount of $600,000. Let's say this person, they owe $300,000 on their mortgage, and we just want to see what the interest rates are, and we'll see what wholesale rates are, and we'll say there's no second mortgage, and we can label it this as test, and say it's a single family home, primary residence. So you go in and let's say they want to do a 30-year fix, or you want to compare, okay, what's a 30-year versus maybe a 15? Okay, so you can see today's rates: 30-year fix on a cash out refinance, 6.75 is at no points. Then you can plug in your broker fee. So really not that bad, basically you can get a fixed rate, and then if they want to do a 15-year, it would be 6.25, no points, and plug in your broker fee. So this is kind of what a cash out refi looks today. But let's say that client who has that $300,000 mortgage has a rate of 2.5%, or maybe they even have a higher mortgage balance. They have a $450,000 mortgage and they have a 2.5%. Well, in that case, we really don't want to put them into this new loan because that's the drawback between the cash out refi is you're replacing the existing loan with a new loan. So um, before we even get to second mortgage options, I feel like sometimes the cash out refinance is not explored thoroughly enough. And I'll give an example of a deal that I have going on right now. Client contacted me. They said, "Hey, I want to get a home equity line of credit. That's what the client wants." I'm like, "Okay, great. I can help you with that." I learned more about the client. Their existing balance on their first mortgage is only like 40,000. So it doesn't even really matter what their interest rate is. The home and the cash out refinance rates are lower on a new first mortgage than it is on a second mortgage, and we'll go over that shortly. So when I broke down kind of the numbers and the math, it was a no-brainer for the client just to do just a new first mortgage, cash out refi, pay off their 40K mortgage that was left over, and get the new mortgage and locked in at a fixed rate. So I do think that sometimes clients come in thinking they know what's right and they want a second mortgage or a home equity line of credit. They've heard about that, but don't just throw away the cash out refi because as you can see, the rates are quite low. So like 6.75 on a 30-year fix. That's in the grand scheme of things, like that's not too bad. So if they have like let's say a 4% rate and they're consolidating all this debt, it still may make sense for them to actually to do a cash out refi. All right, so now let's go through the second mortgage option. So let's say we've exhausted this, we've looked at this and we said, okay, really this client would not benefit from a cash out refi. So now we're going to look at second mortgage options. And again, these are the three reasons why someone would want to tap into their equity. So we got a home equity loan, a home equity line of credit that's fixed, and a variable rate HELOC. Okay, so I'm going to go through a home equity loan first. So, Joel, what is the difference between a home equity loan and a home equity line of credit? Any guesses? All right, Joel's out to lunch. All right, so a home equity loan is a second mortgage that's just like the first mortgage. It's fully amortizing. It's a fixed rate, and you make the payments on the loan just as you're doing on your first mortgage. A home equity line of credit is almost like a credit card where you can pay down the balance. Let's say you can pay down to zero, but it stays open. The line of credit stays open, and then you can tap into the line of credit again. You could pay it down. You could, let's say you have a 250 HELOC and you take 150 to start. Well, you still have 100K left over that you can tap into. What I find is sometimes when I communicate with clients, often the home equity loan is easier to understand because most likely they already have a first mortgage. That's why we're looking at second mortgage options. And it works just like your first mortgage. And I really like the home equity loan program because you can get the fees to be quite low. So let's just run the numbers here with Rocket, one of our preferred partners, and we'll do a home equity loan. We'll say, and we'll do this exact same scenario, but in this case, we'll say that the mortgage balance right now is $450,000. Okay, so they have a $450,000 mortgage balance, and they're going to take out a new loan amount for $150,000. Okay, so you following me? So it's a refinance cash out. It's not a refi. It's a home equity loan. Okay, they have a first mortgage balance of 450. We'll say the property value is 800,000, and they want to take out the 150. So basically, they're going to have a combined loan to value of 75%, so 600,000. All right. So let's run the numbers here on that home equity loan. We could look at 20 and 10-year options. I always like to learn while we're going through it. So you can see here on a 20-year loan. So first, right away, you'd notice the interest rates. So this is why I look at cash out refi first because, oops, I'm sorry, guys, I did this. Yep. So let me go back. Okay. So I'm doing a refinance cash out. It's a home equity loan. 450,000 is the current balance. 150K is the new loan amount. So the combined loan to value is 75%. So 600K is the combined total loan. We're going to run the numbers here. All right, let's just look at the 20-year home equity loan to start. Right away, what you're seeing is lowest rate available, 8.375. Whereas and that's with origination costs. So we saw 6.75, and really you could even go lower on the cash out refi. So that's why I try to first see if the cash out refinance is the better option for the client. So in this case, we have 8.375 on the low option. But what I like about the home equity loan is you can maybe even structure this with very low costs. So you can maybe do a loan at 9.375. Okay, and you can see what the fees are. You can see the fees here are only $1,000 to take out that 150K, which is quite low. So this would be an option for a client to take out a mortgage. Now, in this case, this is a fully amortizing loan. They get $150,000 lump sum, goes wired into their account at closing. Then they start making payments on the loan, fully amortizing, and you can see what their monthly payment is. So these home equity loan, I feel like sometimes it's not. Sometimes, again, going back to clients, they say, "Oh, I want to get a home equity line of credit," and then when I explain what a home equity loan is, that actually might be more attractive to them because it's predictable. It works just like their first mortgage, and they can make the payments on time. They can set up auto pay, and it's just like their first mortgage. All right, let's go back to next option. So then we have fixed rate home equity line of credit. So what this is basically it's similar to a home equity loan, except that the rate is going to be fixed. You could maybe structure it for 30 years. And once the loan has, now different lenders will have different requirements. So one of the variances is full draw may be required. So for example, one of the lenders that we work with, if they do a home equity line of credit for 200,000 or 150,000, let's just say, keep the same example, the client has to take out the full $150,000 at the closing of the loan. So now if they pay off the loan, the line of credit stays open and they can redraw, and it could potentially be a fixed rate. So that would be a second option. We have 3 lenders that offer this, and so we can get them to compete against one another and basically see who's got the lowest rate at the lowest fees. Now we got this is informal. Alicia, go ahead and jump in.
Hey, do they usually have prepayment penalties on HELOCs?
They usually don't. I don't think so. The ones that I have seen that don't have prepayment penalties. Then we have variable rate HELOC. So we have another lender that does this, where basically you take out a line of credit, then the interest rate changes with the market every single day. So, or not every single month, I should say. So for example, we used to work with UWM, one of our former lending partners. They had this product where it was a variable rate HELOC. So this is good for like the risk taker. So if the client wants to, basically if they think rates are going to go down, then hey, you can do a variable rate. And certainly what LoanDesk has to offer is not the only is not the only thing that out there. And often I'll encourage clients, hey, check with your bank, see what they can do too. Because sometimes what banks will do is they can set up a line without a draw, and most lenders will not do this, but there are banks that can set up your HELOC and without drawing on it. And this can be particularly effective for clients who are looking to tap into their equity for an investment opportunity. Because think about it, you don't want to pay the interest on the second mortgage until you identify the opportunity. So let's say you have a client who's looking to add a 250K line of credit because they want to buy a new home. Let's say they want to just buy a new home that's 250,000. Let's say it's in a kind of a lower cost area, so they want to be a cash buyer. So they could potentially set up that line of credit, but not draw on it until they get in contract for the new home. So this is where sometimes working with a bank is better if they can set up the line without having the mandatory draw. And then the variable rate HELOC, that's going to change on a monthly basis. That can be a little stressful for many clients. That's why I often try to encourage the home equity loan. All right, any questions on home equity loans versus home equity line of credits? A little plug for LoanDesk on these HELOC, these fixed rate HELOC. So we have 3 lenders that offer this, and it's like the easiest loan, really, for both from the originator standpoint and from the client standpoint. So what we do is we send a link to the client. They complete their information online. The lender then will give them an offer. They'll run an automated appraisal in the background. If there's enough data, there's no further information that's needed on the appraisal. They give them an offer, and the client can choose to accept that offer. They upload documents, and I've seen this done as fast as 5 days with the funding going out on the 7th day. That's how fast it can be. So, and as a loan originator, it's actually quite easy because we really just have the client complete the online app, and that's it. Our part is done. So if you are thinking about becoming a licensed MLO, or you are licensed MLO, there's really unlimited capacity for the number of home equity line of credits you could do. You could do 100 in a day if you had 100 clients who wanted to take out a HELOC. So get with me if you want to talk about marketing opportunities, because it's really really easy to do, high capacity. Next thing I want to go over, third way to tap into your how a client can tap into their equity is through a home equity investment. Joel, let's see if you're back from lunch. What's a home equity investment? Alicia, you want to take a stab at a home equity investment? If you had to summarize.
I have no idea, so I'm learning something new today.
All right. Okay. Well, I'll say it in a way where where everyone can remember. Basically, you're getting in bed. So you're getting in bed with the company, with investor. And so what I mean by that is you're selling a percentage of your home. So let's say you have a property, and it's let's just say the home value of the property is $500,000. Let's say you own that property free and clear, just to make the math simple. And you want to tap into $50,000 of your equity. So we can go through, now in this case, I would recommend the cash out refi because they don't have an existing mortgage that's tied to a low rate. So that would be the best option. They say, no, we don't want debt. Okay, so if you don't want debt, then number 1 and number 2 really is not an option. What number 3 is you can sell 10% of your home to an investor, and they will give you a $50,000 in cash. They'll go on title, and now they own fractional ownership. So this is actually like something that came out of just in the last 10 years with a lot of venture-backed businesses. So one of the companies that LoanDesk has partnered with is a company called Unlock. Let's see if I can get to their website. So this is a company that we've partnered with. So it's Unlock Your Home Equity. So basically so there's no monthly payments, no interest charges. It's not a loan, it's a home equity agreement. So tough for someone to accept this, because, hey, they want to own their home without encumbrances. But this could actually be a good way for a client to access equity when they don't qualify for a cash out refinance or a second mortgage. So I'll give you an example of where I recently worked with Unlock. The client had a 560 credit score. Client is retired. Client had a lot of debt. We were not going to get that loan approved under any cash out refi or home second mortgage option. So what we did is we partnered with Unlock. They did a home equity investment. The client took the money from the home equity investment. They paid off all their debt. They had a lot of credit cards. So they paid off all their debt. Then they also had to do some home improvement. They had to repair their roof. Now their credit score is rising rapidly, and we can potentially do a second mortgage to now pay off Unlock. So it's not a forever agreement. In some ways, it can be a bridge. Now, Unlock takes their fees. They're going to get their fees, but it is an opportunity for clients to access their equity when they do not qualify for option 1 and 2. And then same thing with doing these home equity loans. If you're a loan originator, it could be really, really easy to monetize that suggestion. It's really more of a link and not handling a full application. Fourth way to tap into equity, and by the way, I am not the expert in this fourth one, but I do know about it, is a reverse mortgage. So Joel, let's see if you're back from wherever you're gone from. What's a reverse mortgage? You're here in spirit. Okay. Anyone want to take a stab at a reverse mortgage? Just if you had to summarize in like two words.
A regular mortgage, but backwards.
Okay, I like that. Yeah, the balance goes up. So you have, when you think about a mortgage, it's amortizing. So that second mortgage HELOC is fully amortizing. This is a fully amortizing. You make the payments. As you make the payments, the balance goes down. Here, the balance goes up because you're getting paid. So this is for folks who want to age in place. So you have, I think it's 62 is the age. Not like 100% positive, but I'm pretty sure it's 62 is the age that you have to be to qualify for a reverse mortgage.
Yes.
Thanks, Paula. Thanks for confirming. And essentially, if you have equity, so take that $500,000 home value. Let's say they have no cash, but they really have no income or very little income. Like, you almost don't want to saddle that person with a $300,000 debt. Like, how are they going to make the payment? They might not even qualify. So there is an opportunity to age in place, and this could be the homeowner can be a monthly installment payment, could be a lump sum, combination of both. So you can have that client where they're receiving now $3,000 a month for however long they end up living in the property. So a reverse mortgage can be really a useful tool for a homeowner who does not want to move. They want to just stay in their home. And again, if you're a part of the LoanDesk team and you have the mortgage license, you would have access to this. And from what I'm told, again, this is not my bread and butter, so I want to just be transparent about that. From what I'm told, it's very lucrative commissions on reverse mortgage. One thing I will say from the people who I know that have sold reverse mortgages, they will often tell you that the client is not the homeowner. The client is often the dependents of the homeowner or the children of the homeowner. And you can understand that children often have fear of what their parents are getting into. They own their home free and clear, and they think, okay, well, they're basically, almost like getting rid or giving away their home, then that they would be inheriting. The reality is it's not necessarily true. The client's children will have 1 year to get the mortgage into their name after the homeowner either dies or moves out of the property. So the children of the clients does have an opportunity to retain the property in the family. And that's why the people who focus on reverse mortgage, they'll often tell me that this is a family sale. You're really educating both the homeowner and the children. So those are the 4 ways that I see. So these are the 3 reasons why someone would want to tap into home equity. You got home improvement. So if you know anyone who maybe wants to do a remodel, they want to do a pool installation, you have, or maybe a ADU. These are popular now, especially in parts of California where ADU laws have changed. You have debt consolidation. So credit card debt remains very, very high. Great reason to tap into your equity would be to pay off higher interest debt. That's in some ways that's the easiest presentation. Hey, you're paying off 20% interest rates with a 9% interest rate. Okay, no brainer. Investment opportunities. Your home equity line of credit, the equity in your home is acceptable source of funds. So we have clients that are buying investment properties and they're essentially putting 0 down because let's say they have $1 million primary residence, they've got $500K mortgage balance, they're taking out a $250K home equity loan, and then they're going out and buying an investment property, let's say for $700,000, and you put the $250 down, and that is an acceptable source of funds for the down payment. And essentially they did not tap into any brokerage account or didn't tap into their savings, and they were able to buy that investment property. So these are the 3 reasons I see. Here are the 4 ways to tap into your equity. You have cash out refinance, you have second mortgage options, which home equity loan, home equity line of credit, variable rates. On a HELOC, you have a home equity investment, and you have reverse mortgage. And that brings us right to 1 o'clock. So if there's not any, if there's any questions, we have 1 more minute.
There's no questions, and we'll go ahead and wrap up for today. Thank you so much, Joe. This was super informative. I hope everyone was able to have something to take away from this. I know I did. I love attending these because I have not bought my first home yet, but when I do, I've got all this knowledge stored away for that. So thank you, Joe. Thank you to the LoanDesk team. We do these rooms pretty much every week on Tuesday at 12:30 PT. So we'll be here again next week, and I hope everyone has a great rest of their Tuesday. Thank you all so much for joining us today.
Thanks, Hila.